Good morning, everyone. I'd like to welcome you here to our annual not-for-profit seminar that we have here. I guess since I'm up here, I'm just going to kick off here navigating the latest accounting standards here uh, for the organizations here, and a little bit of background here about myself. I have 32 years, but like I said, it's going to be 33 years. I joined the firm many years ago, seems like. Graduated from Shippensburg University, and I've worked with nonprofits and affordable housing my whole career at SEK. So I feel very comfortable in that arena there as well, here for the organization. I do want to say as we move on here to the accounting standards update, I'm just going to hit on three of them. Some of these you have already implemented. People here have already implemented these. There is one here that probably none of you have implemented because it's not effective yet, and that's credit losses, dealing with those. Just want to point out that I'm sort of thankful we don't have a lot of new accounting standards really affecting the not-for-profits right now after going through revenue recognition and some of the other changes we had in preparing for the lease standard, which some of you have implemented already and some of you will be implementing. I'm kind of happy to have a break from having to do that. Some of the things you didn't have to deal with, we had to on our side, was the new audit standards that came out as far as how our audit reports. That was the most visible item which you would have saw that changed, but the additional work behind the scenes that we have to do was in there as well. So I'm happy this where we're at right now. So the first one I'm going to go over here is the lease accounting standards. I just want to point out some things. As a point of reference, the leasee would be the person who's renting something. The leasee had the biggest change in this new accounting standards, having to record assets, having to record liabilities, additional disclosures. If you're leasing something to somebody else as a leaser, your accounting was basically unchanged. Okay, but it still falls underneath this standard because it covered both sides of the transaction. So just let that know. And so it's really the person who's the leasee is going to see the big impact on their statement. The leaser would not. It became effective for non-public entities as of January 1st, 2020, which means for any December 31st, 2022 year ends or year ends in 2023, this standard here will be effective. Now, I do want to point out, having their non-public, you might ask what that is. The accounting standards define you have what they call, you can be a quote, treated as a public entity if you have, be treated as a public entity if you have conduit debt, and that would be like the municipal authority issues debt, and then a investment house like a Wells Fargo or Lake Mason actually issues it out to the public. But I have a few of those clients, they actually had to adopt this several years ago. So they were already doing this. But for everybody else who doesn't have that debt, this would be effective here. One thing, the big change here is going to require that all leases be accounted for in the balance sheet and your statement of activities or income statement, whether they're operating or capital. We've always had the capital lease issue under generally accepted accounting principles, but now we also got to pick up the operating leases as well. What ends up happening, you record a right of use asset, and you're going to record a liability based on the present value of that calculation. If you have an operating type lease, you're going to amortize that right of use asset over the term of the lease. As you make your payments, obviously, you'll be reducing the liability and recording the interest expense on that. So after you start into it, your two balances don't necessarily match up due to the way you're amortizing the straight line on the one side and then the effective interest on the liability side of the balance sheet here that you have. Now, this is effective for all leases with a term in excess of 12 months that you might have. So if you only have month-to-month leases, that wouldn't pertain. The caveat here too, I want to point out is that you got to look at the complete term. So if you have it might say 5 years, but if there's additional terms, like maybe it gives you a first 5 years and two 5 year options for a total of 15, at the time you're looking at this, you got to think, well, how long are we going to be there? If you think you're going to be there for 15 years, then you would book that asset based on a 15-year lease term. If you only think you're going to be there 10 years, then you would only use 10 years for that. Part of it is not just what it says, I would say stated lease term that you have to comply with, but it's also any additional lease terms you have to figure out if you're going to be in that situation longer than the stated initial lease terms for this. Now, one thing nice about this is in adoption of this, when you adopt it, you can do a prospective approach, which means you don't have to go back and restate the leases. You treat the lease as though it came into effect as of the first day of your fiscal year that it applies to, and make an adjustment at that time to bring it onto your books and record. So there is transitional relief there for the organizations in adopting this here. For those who have not implemented this, and this is really those who've implemented and going through it with us, and there's some in here who have done that, they've already experienced this pain of, of going through lease terms. The first thing is if your audit's coming up, or if you're getting a review or full disclosure compilation in accordance with generally accepted accounting principles, is gather your leases now and make sure you have that information. That's one of the biggest things, is trying to gather the leases. Also be aware of contracts and what they call embedded leases within your contracts. Embedded leases are things such as, give you an example, back 20 years ago, 25 years ago, hospitals used to do interocular implants. And the one company would say, hey, we got this piece of machinery. You can use it for free if you buy all your implants from us. Now, everybody knows that you don't get anything for free. That was what they call an embedded lease, because that there was a value for that equipment, and that was embedded in the price of those implants that they were using. So you end up so that's the type of things that we look for. Something where somebody says, "We'll give you this, and you get to use this piece of equipment for free." Okay, so that's one thing to be aware of. And they call those embedded leases because it's not apparent. It's embedded within the contract and what you're using there. Other things to consider here is the discount rate when you get there. I do want to point out with the discount rate, if you use a higher discount rate, the lower your asset and liability is going to be when you book it. The lower the discount rate, because you're not discounting as much, the higher those items are going to be. And that is something we as the auditors here actually uh, look at, because that makes a difference. You might say, well, how does that affect us? And the for-profit side has run into this, where clients have debt covenants, where they have debt to equity ratios, and they want the debt to be as low as possible. So they come out and say, we have an 8% discount rate. And you ask them, where did you get that? Well, it works our debt covenant ratio. That was the one response. That's not how it works. But so there has to be some guidance. Now, that you can elect to use the treasury rate as a risk-free rate, but you have to make sure that you match the term of the treasury rate up to the term of the lease. So if it's a 10-year lease, you're going to be using a 10-year treasury rate for that. Obviously, with this new lease standard here, as you implement, there's enhanced disclosures. Some of the things is the discount rate, cash flows needs to be broke out separately with that information, and the assumptions that you're using in setting up those leases as well. There are things. Now, here's some of the observations that we've noticed here since we've had about 6 months we've been dealing with this. One is the lease liabilities are larger than people ever imagined. It could be once they put the paper and pencil and do the calculations. Also, confusion on what discount rate to use. Do we want to use the treasury rate? Do we want to use something else? But the other rate has to be a supportable rate. It has to be something that you be based on your current lease terms or loans you have outstanding. But there has to be something that supports that. And the other one is unknown terms in the leases, or lease terms that have changed but no one documented them over time. That's when we tend to run into. We had a lease with this landlord, the 15-year lease. Oh, by the way, we took more space and we adjusted lease, but we don't have anything to say what it is now. We agreed on a handshake that we pay, $400 to $1,000 more a month, but we don't have anywhere that's documented. So they're the type of things to be aware of. I would say with regards to that, use that then as an opportunity to get your leases up to date and get everything in line as far as that goes with the terms and stuff and what you're actually paying there with the leases. This is one that actually was effective last year, but we thought it was good to just remind everybody what this is. There's a standard came out now to account for contributed non-financial assets here. And the question becomes here, what is a non-financial asset? Like I said, it was effective last June, effective for December 31st or any other year ends up through June 30, 2023 here. What we're talking about here is if somebody needs lands, buildings, supplies, automobiles, those type of things, this here sets the guidance for how that items is reported. And I bring that up from the standpoint of you may be getting these items now, but think not it happens all the time. Maybe you're getting supplies. Maybe you've been getting free rent, but you just don't think of it. That we've had a lot of things come up as we've been doing this where people haven't really thought about this. So even if you've been through your audit, but now recognize that these items are out there, please let us or your auditors know what's going on there with that you have these non-financial assets. On the healthcare side, it's big where companies will donate vaccines. They'll get free vaccines. They'll get free medical supplies from certain types of medical suppliers. That's the type of items that would fall underneath this, because it's not cash, it's not investments, but it's other items. So what does this require? This basically requires that there's a separate line on the income statement or your statement of activities that lists non-financial assets so that you can see what the contributions were that you received during the year. It also requires then within the notes to have disclosures about how they were used. Typically, if someone gives you a supply and you use it that year, you think about the accounting, it has no impact on the bottom line because your revenues increased by, let's say, $5,000 and your expenses increased by that. But they want you to know, they want to know where that is on the financial statement and what that $5,000 donation of those items were used. Okay. So there's much more disclosures that relate to that, but the big thing here is just review the items that you're getting during the year, and you because you may have these items, but not just give it any thought that you're actually receiving these items. Also, some of the enhanced disclosures with this, they want to know the policy here on liquidating rather than using contributed non-financial assets. So they want to know: do you liquidate them? If you sell them, do you use them internally? Qualitative considerations on whether the non-financial assets were liquidated or used during the terms. And like I said, a lot of this you can find in the statement of activity. If you say what it's used for and you give the line, people should know what that is. Also, whether there is any restrictions on those items. I want to know the valuation inputs. And at the bottom is kind of strange. I would ask why anybody would take a donation where you're restricted from selling or you're restricted on the use of the non-financial asset. And it might be, let's say somebody says, I want to give you land to use to build a youth home on. So right there, and you can't sell it. So my question was, unless you really want to build a youth home, why would you even accept that donation in that case there? But obviously, if somebody gives you and puts those restrictions, your valuation of that is really restricted of what it can be used for. So hence comes the problem with the valuation method that they're trying to address here in that situation. Because once you have the land, if you can't sell it, it's one thing trying to sell a stock or donated security or not being able to comply with an trust or something, having to just give that away. But one thing when you have land obviously is hard to sell, and so there's some issues there with that. So the next item is a new standard that will become effective here within the next 2 years, and this has to do with credit losses. It's called current expected credit losses. The acronym, because we love acronyms in accounting, is CECL, CECL. So you ever heard the term CECL out in the accounting world? This is what they're talking about. The question is, how did this come about? This is a result of the market crash that occurred in 2008. And as it relates to financial institutions, being banks, the impact of the credit situation that occurred and the increase in loan losses was never really reported on the large banks' balance sheets until a couple years later as the history came in. Because the current accounting standards is based on an incurred probable loss. and looking at historical data. So when they're looking at historical data in end of 2008, it was, hey, based on these years, everything's been tracking pretty good. We don't really have any issues here that we would need to put for gap. But obviously, a year or two later, then they started reporting losses. But the losses actually had occurred back in 2008. So, like, how do we correct that? So, one of the standards they come up with is this model here, which is a much more forward-looking model we have here. You might say, well, we don't do loans like a bank, but if you have any trade receivables, this applies to you. So it's basically anything where you have a right to receive cash here for the organizations. So keep that in mind here. So it does impact anybody that would have any type of trade receivables on your books here. As I mentioned, current gap uses an incurred loss model and has to be probable, but this new model, it will allow financial statements to report not only probable losses, but also credit losses that are expected, but not yet probable to occur. And you're going to have a broader range of reasonableness and supportive information. The banks that have gone through this, we had a board presentation about 2 months ago, and the person who helped explain this the best for us, for the client, was actually a CEO of a local financial institution who explained how much money they spent trying to comply with this, how many questions they were asked by their auditors, and the amount of time it took to build these tables and try and basically read the tea leaves of what's going on currently so you can recognize those losses now. So some of the things you would be looking at is if you're in a community, if I was a banker, I'm going to use that example. And this year, one of the biggest employers uh, left town or closed the factory and have 1,000 people laid off. I can't just look at the year prior and say we don't have an issue. I got to say, how's that going to impact our balance sheet? And I'd have to take into account the fact that they didn't have that there's people gonna be struggling out there to make the payments now versus 2 years from now, to give you a background. Question is, if you can see that the only way to get a real answer is to get your crystal ball out. Mine broke, but if you have one that works, I'll be willing to take a look at it. But essentially, that's what they're trying to do. So it's much more broader than just looking at history. It's like, what are the current trends now that we gotta be concerned about in making these? Okay, what types of data available, information, past events, current conditions. Though we can start historical data, we must consider other things there. Also, you'll love this. There's no guidance on how to account for your setting your allowances now. It's really up to the organization, and management's free to determine how best they can do that here. There are several current methods here: discounted cash flows, loss rate, roll rate, and aging schedule method, where you look at an aging schedule and apply a percentage. But all of those will need to factor in now this forward-looking information that's going to have to be put into the statements here for this. So it's going to be more work at the end of the year looking at the allowances and just, well, we know this person here hasn't paid for 6 months. We've got a letter saying this person here, they're in bankruptcy. It's going to take more than that. It's going to be okay, but who else on here is going to have problems that we don't know? Is there any way we can gauge what that is? Now, this goes into effective for years beginning after December 15th, 2023 here. So